7 Rules Every Smart Investor Learns Early. Part 1. The Foundation of Smart Investing. Preparing Your Mind and Your Money. Written and published by Mindset Masters Audiobooks. Investing is more than buying and selling assets. It is a mindset, a strategy, and a lifelong discipline. Those who build lasting wealth understand that success is not about luck, timing, or following trends. It is about cultivating a mindset of deliberate action, continuous learning, and disciplined decision-making. Smart investors think differently from the start. They understand that money is a tool, risk is an opportunity, and time is the most valuable resource. They recognize that financial freedom is the result of intentional habits compounded over years, not the result of a single lucky trade or a sudden windfall. Why investing early matters. One of the most important lessons every investor must learn is the power of starting early. Time is the greatest ally in wealth creation. Even modest investments, when started early and managed intelligently, compound into significant financial power over decades. Waiting to begin investing is one of the most expensive mistakes a person can make. Starting early also allows you to learn, adapt, and refine your strategy with minimal risk. The market rewards patience and disciplined action. Those who begin with awareness, curiosity, and purpose position themselves for long-term growth, while those who delay face the challenge of playing catch-up. The role of mindset in investing. Before you can become a successful investor, you must master your mind. Your beliefs, habits, and emotional responses determine how effectively you manage risk, respond to opportunities, and sustain growth. A strong investing mindset includes discipline, following a plan consistently rather than reacting to emotion or hype. Patience, understanding that compounding and growth take time. Curiosity, constantly seeking knowledge about markets, trends, and strategies. Resilience, maintaining composure in volatility, setbacks, or losses. Confidence, making informed decisions without being paralyzed by fear or uncertainty. Without the right mindset, even the most promising investments can fail. Wealth is created in the mind before it manifests in your portfolio. The purpose of this audiobook. This audiobook is designed to guide you through the 7 rules every smart investor learns early. Each rule is a cornerstone principle that, when applied consistently, builds financial intelligence, reduces risk, and maximizes opportunity. Rather than overwhelming you with theory or abstract concepts, each rule will be explained in detail. Why it matters. How it applies in real-world investing. Practical, actionable steps you can implement immediately. Mindset shifts that make the rule effective. Common mistakes to avoid. By the end of this audiobook, you will not only understand the rules, but you will have a blueprint to think, act, and invest like a smart investor. The journey ahead. In the next parts of this audiobook, each of the 7 rules will be explored in depth, one per segment. This structure allows you to absorb each principle fully, understand how it applies to your personal and financial life, and take actionable steps before moving on to the next rule. Along the way, we will also discuss strategies for integrating these rules, managing risk intelligently, and creating a long-term vision for wealth. You will learn how the combination of mindset, strategy, and discipline compounds to produce extraordinary results. This journey is about more than accumulating money. It is about mastering the mindset of wealth, developing habits that create consistent results, and gaining the freedom and confidence to make your money work for you. What makes a smart investor? A smart investor is not necessarily the one with the largest portfolio. It is the one who makes informed decisions, anticipates challenges, and capitalizes on opportunities with intelligence and discipline. Smart investors understand that knowledge is their most valuable asset. Value patience over instant gratification. Approach risk strategically rather than emotionally. Invest consistently, not sporadically. Learn from mistakes instead of being paralyzed by them. Build a long-term plan instead of chasing trends. This audiobook will teach you to adopt these characteristics, helping you create a foundation for financial freedom that will serve you for a lifetime. Setting yourself up for success. Before diving into the 7 rules, take a moment to prepare yourself. Commit to the process. Treat this audiobook as a guide, not entertainment. Take notes. Reflect on each idea and how it applies to your life. Be patient. The most powerful investing lessons compound over time, just like money. Practice discipline. Apply one insight at a time, building consistency. Align mindset with action. Knowledge alone is not enough. Action multiplies results. Your journey as a smart investor begins now. The principles you will learn are timeless, and the sooner you embrace them, the faster you will see results. Looking ahead. The first rule we will explore in Part 2 focuses on starting early and thinking long-term. It is the cornerstone of smart investing, and understanding it fully will shape how you approach every decision, risk, and opportunity in your financial life. Remember, investing is a lifelong practice. There are no shortcuts, but there are rules, strategies, and mindset shifts that can dramatically increase your likelihood of success. By embracing these early, you position yourself ahead of the majority and set the stage for compounding knowledge, confidence, and wealth over time. Part 2. Rule 1. Start early and think long-term. The first rule every smart investor learns is simple in concept but profound in impact. Start early and maintain a long-term perspective. While many investors chase quick wins, high-yield schemes, or speculative opportunities, those who succeed consistently understand that time is the ultimate multiplier in wealth creation. Early action combined with a disciplined, patient mindset can transform modest investments into extraordinary financial power. The power of time. Time is the most undervalued asset in personal finance. Many people focus on the amount of money they have or can earn today, but fail to recognize that the duration over which money grows is more important than the initial amount. Compounding is the principle that allows money to generate returns, and those returns themselves generate further returns. The earlier you start, the greater the compounding effect. To illustrate this, imagine two investors. Investor A begins investing $200 a month at age 25 and continues for 20 years. Investor B starts investing $400 a month at age 35 for 10 years. Even though Investor B contributes the same total amount as Investor A, the first investor often ends up with significantly more wealth due to the compounding advantage of time. This example highlights a critical lesson. It's not the size of your first investment, but the length of time it has to grow that matters most. Overcoming the fear of early investment. Many beginners hesitate to invest early, thinking they do not have enough capital or fearing they might make mistakes. This mindset is the primary obstacle to building wealth. Smart investors recognize that the act of starting early is itself an investment in experience, knowledge, and confidence. Every early investment teaches lessons about market behavior, risk tolerance, emotional responses, and decision-making processes. Even small mistakes become valuable learning opportunities that compound over time, much like financial returns. Delaying action, on the other hand, deprives you of both growth and experience, creating unnecessary challenges later in life. Developing a long-term mindset. Investing with a long-term perspective requires a shift in thinking. The average investor focuses on short-term gains, reacting to daily market fluctuations or trending opportunities. Smart investors understand that wealth is not built in months but over years and decades. A long-term mindset includes ignoring short-term market noise and volatility, prioritizing investments with sustainable growth, avoiding emotional decisions driven by fear or hype, committing to consistent contributions regardless of market conditions. This approach is not passive. Long-term investing requires continuous evaluation, adjustment, and learning, but it avoids the traps of impulsive decisions and speculation. Practical steps to start early. Assess your current financial situation. Understand your income, expenses, and potential to invest. Even small contributions matter when invested consistently over time. Create a budget for investing. Allocate a portion of your income every month for investments. Consistency outweighs amount. Choose simple, scalable investment vehicles. For beginners, consider index funds, ETFs, or retirement accounts. These provide diversification, low fees, and compounding benefits. Automate contributions. Setting up automatic monthly investments removes the need for constant decision-making and ensures consistency. Educate yourself continuously. Knowledge compounds like money. The earlier you begin learning about investing, the more advantage you gain over time. Be patient and avoid short-term temptations. Resist the urge to withdraw or react to temporary losses. Understand that volatility is part of growth. Case study: the advantage of early action. Consider a young professional named Sarah. At age 22, she invests $150 per month in a diversified portfolio of index funds. By the time she reaches 45, her portfolio has grown significantly due to consistent contributions and compounding returns. Contrast this with Michael, who waits until age 30 to start investing $300 per month. While he contributes the same total capital, the shorter time horizon means he ends up with far less wealth than Sarah by age 45, despite investing double per month. The lesson is clear. Starting early allows compounding to work in your favor, turning small, consistent investments into life-changing wealth. Mindset shifts for early investors. Value time over money. Understand that the sooner you start, the more time your money has to grow. Small contributions made consistently are more powerful than large sums contributed later. Focus on process, not perfection. You do not need to make perfect investments to benefit from starting early. Consistency and learning are more valuable than flawless execution. Think in decades, not months. Set goals that span years and decades. Visualize the wealth you want to create long-term and align your actions accordingly. Embrace learning through action. Early investing is a form of education. Each investment provides insights into risk, markets, and your personal behavior as an investor. Common mistakes to avoid. Waiting for the perfect time. Markets are always moving. Delaying action wastes time, the most powerful wealth-building tool. Overemphasizing short-term gains. Focusing only on quick returns encourages risky behavior and undermines compounding. Ignoring small contributions. Even modest, consistent investments accumulate over time. Every contribution matters. Reacting emotionally to losses. Early investors must learn that temporary declines are normal and often present opportunities to buy assets at discounted prices. Actionable steps to internalize Rule 1. Commit to starting now, no matter the amount. Open an investment account that allows consistent monthly contributions. Set clear, measurable long-term goals. Track progress, but do not obsess over short-term fluctuations. Review your portfolio periodically, adjusting only for long-term strategy improvements. Reflect on lessons learned from early investments and apply them to future decisions. By mastering the principle of starting early and thinking long-term, you lay the foundation for all other smart investing rules. Time, patience, and disciplined action are the cornerstones upon which wealth is built. Part 2 establishes the mindset and practical habits necessary to take immediate action, ensuring that you are ready to absorb and implement the remaining rules effectively. Part 3. Rule 2. Diversify to protect, not just to grow. The second rule every smart investor learns is that diversification is not optional. It is essential. While it is tempting to chase the highest returns in a single stock, cryptocurrency, or a hot investment, history and experience consistently show that concentration increases risk dramatically. Smart investors understand that wealth is preserved and grown by spreading capital across multiple assets, markets, and strategies. Diversification is the tool that transforms uncertainty into opportunity while safeguarding your financial foundation. Understanding diversification. Diversification is the practice of spreading investments across different asset classes, sectors, and geographies to reduce risk. The goal is not just to increase returns, but to protect your capital from unpredictable events. Markets are influenced by countless factors, including economic cycles, political changes, global crises, and human behavior. No single investment is immune to volatility. By diversifying, investors ensure that a decline in one area does not destroy overall wealth. For example, if a single stock in your portfolio drops 50%, a diversified portfolio may only decline a few percentage points because other assets are performing differently. Smart diversification is intentional, not random. It balances growth potential with stability, enabling consistent wealth accumulation without exposing yourself to catastrophic loss. Types of diversification. Successful investors diversify in multiple dimensions. Asset class diversification. Assets can include stocks, bonds, real estate, commodities, private equity, or cash equivalents. Each class behaves differently under various market conditions. For instance, when equities decline, bonds often provide stability, while real estate may appreciate steadily. Sector diversification. Within asset classes, spreading investments across different industries reduces sector-specific risk. For example, investing solely in technology stocks exposes you to industry downturns, while including healthcare, energy, and consumer goods creates balance. Geographic diversification. Global markets move independently of each other. By investing in both domestic and international markets, investors reduce the risk associated with a single economy or currency. Geographic diversification also opens opportunities for growth in emerging markets. Time diversification. Consistently investing over time, rather than attempting to time the market, is another form of diversification. Dollar-cost averaging allows you to buy assets at varying prices, reducing the impact of market volatility and building long-term growth. Risk-level diversification. Combining high-risk, high-reward investments with conservative, stable options ensures that your portfolio can withstand market fluctuations while still capturing growth opportunities. The psychology behind diversification. Diversification is not just a technical principle, it is also psychological. Concentrated investments often provoke fear, anxiety, and impulsive decision-making. Investors may panic during downturns, sell at a loss, or make speculative moves to recover quickly. By contrast, a diversified portfolio reduces emotional pressure. When one asset underperforms, other investments provide balance, allowing investors to stay disciplined and focused on long-term objectives. This emotional stability is crucial for consistent wealth building. Diversification is not about mediocrity or settling for average returns. It is about protecting what you have while participating in multiple growth opportunities. It allows you to take calculated risks without jeopardizing your entire financial future. Common mistakes in diversification. Over-diversification. Some investors spread themselves too thin across dozens of assets, diluting returns and making management difficult. Smart diversification is intentional, with a focus on quality assets in each category. Under-diversification. The opposite mistake is concentrating investments in a single stock, industry, or asset class. This exposes investors to unnecessary risk and potential catastrophic loss. Neglecting alternative assets. Many beginners limit themselves to stocks and cash. Including real estate, commodities, or private investments provides additional layers of protection and growth. Ignoring market cycles. Diversification is dynamic. Markets evolve, and sectors or assets that were stable may become volatile. Smart investors review portfolios regularly to maintain balanced exposure. Case study: the power of diversification. Consider an investor named David. He has a portfolio evenly divided among domestic stocks, international stocks, bonds, and real estate. During a global tech crash, his domestic technology holdings lose 30%, but his international stocks and bonds remain stable or even grow. Overall, his portfolio declines only 5%, preserving most of his capital. Compare this to Emma, who invested solely in domestic tech stocks. During the same crash, her portfolio plummets 30%, wiping out years of gains. The difference is diversification. Diversification does not guarantee profits, but it guarantees protection against avoidable loss. It provides a safety net that allows investors to take calculated risks while maintaining long-term stability. Practical steps to diversify your portfolio. Identify asset classes. Determine which types of investments suit your risk tolerance, time horizon, and financial goals. Stocks, bonds, real estate, and cash equivalents form a basic diversified foundation. Assess sector exposure. Within each asset class, diversify across industries to avoid concentration risk. Track trends and avoid overexposure to any single sector. Consider global opportunities. Include international assets or global ETFs to reduce dependence on a single economy and capture growth in emerging markets. Balance risk levels. Mix high-growth, higher-risk assets with conservative, income-generating investments to maintain portfolio stability. Rebalance regularly. Periodically review your portfolio to maintain intended allocation. As some investments grow faster than others, rebalance to preserve diversification goals. Seek professional guidance if needed. A financial advisor can help design a diversified portfolio aligned with your goals, risk tolerance, and timeline. Mindset for effective diversification. Think protection, not just growth. Wealth is preserved when risk is managed intelligently. Patience is essential. Diversification provides long-term stability, not instant results. Discipline prevents emotional decisions. Avoid chasing trends or reacting to short-term volatility. Flexibility enhances opportunity. Adjust allocations as market conditions and personal goals evolve. Smart investors do not gamble. They protect their foundation while pursuing growth. Diversification ensures that your journey toward financial freedom is resilient, sustainable, and adaptable. Actionable steps to internalize Rule 2. Review your current investments and assess concentration risk. Spread investments across at least 3 different asset classes. Diversify within each asset class by sector, region, or type. Automate contributions across multiple investments to maintain consistency. Schedule quarterly portfolio reviews to rebalance and optimize diversification. Educate yourself continuously about alternative assets and global opportunities. By mastering diversification, you create a portfolio that withstands uncertainty, maximizes growth potential, and provides peace of mind. The principle of spreading risk is not just about protecting capital, it is about enabling smart, confident, and strategic investing. Part 4. Rule 3. Understand risk before reward. The third rule every smart investor learns is the principle that risk must always be assessed before potential reward. While many new investors are drawn to opportunities promising high returns, those who build lasting wealth understand that every opportunity carries risk, and successful investing begins with understanding and managing that risk. Reward without risk assessment is speculation, and speculation often leads to unnecessary loss. The nature of risk. Risk is a natural part of investing. Every asset, from stocks to real estate to bonds, carries uncertainty. Prices fluctuate, markets shift, economies change, and unexpected events occur. Risk is not something to fear but something to understand and manage strategically. Successful investors view risk as an opportunity to gain insight and make calculated decisions. They recognize that avoiding risk entirely often results in stagnant growth, while taking uncalculated risk can destroy wealth. Understanding risk is the bridge between caution and opportunity, allowing investors to act decisively with confidence. Risk versus reward, the fundamental trade-off. Every investment involves a balance between risk and potential reward. High returns are usually associated with higher risk, while low-risk investments tend to provide stability with moderate growth. Smart investors learn to evaluate. What is the potential reward of this investment? What is the worst-case scenario? How much loss can I tolerate without jeopardizing my financial stability? How does this investment fit within my overall portfolio strategy? By answering these questions, investors make informed decisions rather than emotional or impulsive ones. Understanding risk ensures that even when losses occur, they are manageable and do not derail long-term goals. Types of investment risk. Investors encounter multiple types of risk, and each must be considered carefully. Market risk, the possibility that overall market conditions will reduce the value of investments. Stocks, for example, can decline due to economic downturns, geopolitical events, or market sentiment. Liquidity risk, the difficulty of converting an investment into cash without significant loss. Some assets, like real estate or private equity, may take time to sell, affecting access to funds. Credit risk, the risk that a borrower or counterparty will default on obligations. Bonds, loans, and corporate investments carry varying levels of credit risk. Interest rate risk, changes in interest rates can affect the value of bonds and other fixed income investments. Rising rates typically decrease the market value of existing bonds. Inflation risk, inflation erodes purchasing power over time. Investments that do not outpace inflation lose real value, even if nominal returns appear positive. Operational or business risk, the risk that a company or investment will fail due to poor management, competition, or structural issues. Event risk, unforeseen events such as natural disasters, political upheaval, or regulatory changes can impact investments dramatically. Smart investors do not fear these risks, they identify, quantify, and plan for them, building resilience into their strategy. Calculating risk, practical tools. Understanding risk involves both qualitative and quantitative analysis. Historical data, review past performance, volatility, and trends to anticipate potential outcomes. Scenario analysis, consider best case, worst case, and most likely scenarios to evaluate potential gains and losses. Diversification, spreading investments across multiple assets reduces exposure to any single risk. Risk tolerance assessment, reflect on your financial goals, time horizon, and emotional capacity to handle losses. By combining these tools, investors create a framework that balances opportunity with protection, allowing them to pursue rewards without jeopardizing their financial foundation. The psychology of risk. Emotional intelligence is critical in managing risk. Many investors allow fear or greed to dictate their decisions. Panic during market downturns leads to selling low, while overconfidence during booms encourages reckless buying. Smart investors train themselves to respond rationally to volatility. They maintain composure, adhere to strategies, and evaluate risk objectively. This emotional discipline transforms risk from a source of stress into a tool for strategic growth. Case study: risk assessment in action. Consider two investors, Alex and Jordan, evaluating a potential stock investment. Alex focuses only on potential returns and invests heavily in a single high-growth tech company. When the stock experiences a sharp decline, Alex panics and sells at a loss, erasing years of gains. Jordan performs a thorough risk assessment, analyzing the company's fundamentals, competitive landscape, financial statements, and market conditions. Jordan invests a balanced amount within a diversified portfolio. When the stock drops, the impact is manageable, and the long-term growth potential remains intact. The difference is clear. Understanding risk before reward allows Jordan to act confidently and strategically, while Alex's impulsive approach leads to avoidable loss. Practical steps to assess and manage risk. Evaluate the worst-case scenario. Determine the maximum potential loss you can tolerate. Measure probability of outcomes. Understand the likelihood of both gains and losses. Balance risk and reward. Ensure potential returns justify the associated risks. Use diversification as a safety net. Spread risk across multiple assets, sectors, and geographies. Implement stop-loss and protective measures. For volatile assets, consider strategies that limit downside exposure. Continuously reassess. Markets evolve, so regularly review investments and adjust risk assessments. By applying these steps consistently, investors transform uncertainty into calculated opportunity, positioning themselves for long-term success. Mindset shifts for risk management. Fear is a signal, not a stop sign. Evaluate why you feel fear and assess if it is rational or emotional. Losses are lessons, not failures. Every setback provides insight to refine strategy and improve decision-making. Plan for volatility. Accept that markets fluctuate. Preparation ensures stability. Risk is necessary for growth. Without some risk, returns are limited. The goal is not to avoid risk entirely but to manage it intelligently. Understanding and managing risk is the backbone of smart investing. Those who master this principle can pursue higher returns with confidence, knowing that they are protected against avoidable losses and equipped to navigate uncertainty. Actionable steps to internalize Rule 3. List all potential investments and identify inherent risks. Assess the probability and impact of worst-case scenarios. Evaluate whether potential rewards justify the calculated risk. Integrate risk management strategies, including diversification and protective measures. Develop a personal risk tolerance profile and align investments accordingly. Monitor and review investments regularly to adjust for changing conditions. Practice emotional discipline when faced with market volatility. By fully understanding risk before seeking reward, investors build a foundation that allows for calculated growth, reduces unnecessary losses, and positions them for long-term financial success. Part 5. Rule 4. Embrace continuous learning. The fourth rule every smart investor learns is the importance of continuous learning. While strategy, discipline, and risk management are essential, none of these tools are effective without a commitment to ongoing education. Financial markets, investment instruments, and global economic dynamics are constantly evolving. Investors who fail to adapt and learn are left behind, while those who commit to mastering knowledge gain a long-term edge. The ever-changing world of investing. Investing is not static. Each day brings new information, changing economic indicators, corporate developments, and emerging technologies that impact markets. A strategy that works today may not work tomorrow, and opportunities that existed a decade ago may no longer exist. Smart investors recognize that learning is not optional. It is the foundation of adaptability and survival. Continuous learning allows them to anticipate trends, understand complex market forces, and make informed, timely decisions. Knowledge compounds just like money, giving those who seek it a distinct advantage. Why learning separates successful investors from the rest. Many beginners rely solely on intuition or follow trends without understanding the underlying principles. These investors may experience short-term wins but often fail in the long term. Knowledge is the differentiator. Informed decision-making. Understanding financial statements, market trends, and economic indicators reduces reliance on luck and intuition. Confidence and discipline. Knowledge mitigates fear and uncertainty, allowing investors to act decisively during volatility. Adaptability. Continuous learning enables investors to pivot strategies, recognize emerging opportunities, and minimize losses. Long-term advantage. Investors who accumulate knowledge over years build an edge that compounds alongside their financial assets. Learning is not limited to books or courses. It includes observing markets, analyzing past investment decisions, and learning from both successes and failures. Key areas of financial learning. To grow as an investor, focus on these critical areas. Market fundamentals. Understand how stock markets, bonds, commodities, and other asset classes function. Investment analysis. Learn to evaluate financial statements, company performance, valuation metrics, and competitive positioning. Economic indicators. Follow interest rates, inflation, GDP growth, unemployment data, and other macroeconomic factors. Behavioral finance. Study investor psychology to recognize biases, herd behavior, and emotional pitfalls. Global events. Monitor geopolitical developments, international trade, and emerging markets to anticipate opportunities and risks. Alternative investments. Explore real estate, private equity, commodities, cryptocurrencies, and other non-traditional assets. Technology and trends. Stay informed about technological innovations that impact industries, disrupt markets, and create new investment avenues. Mastering these areas provides the knowledge base necessary for making intelligent investment decisions and navigating complex markets. How to make learning a habit. Continuous learning requires intentional habits. Smart investors integrate learning into daily routines, ensuring consistent growth over time. Daily reading. Spend at least 30 to 60 minutes reading financial news, analysis, or reports. Weekly analysis. Review portfolio performance, study market trends, and reflect on lessons learned. Monthly review. Deep dive into new investment strategies, company reports, or economic developments. Networking. Engage with other investors, join forums, or attend webinars to exchange insights and perspectives. Journaling. Record decisions, thought processes, and lessons from successes and mistakes to reinforce learning. By treating education as a lifelong habit, investors stay ahead of market changes and continuously improve their decision-making abilities. Case study. Learning in action. Consider Lisa, an investor who began her portfolio with limited knowledge. She committed to learning daily, reading financial reports, following market trends, and studying company performance. Within 5 years, her understanding of risk, valuation, and portfolio construction surpassed peers who had more capital but less knowledge. When a market downturn occurred, Lisa recognized the opportunities to buy undervalued assets, while many others panicked and sold. Her portfolio not only survived the volatility but grew significantly. Knowledge gave her confidence, clarity, and control. In contrast, her peers who did not prioritize learning made reactive decisions, chased trends, and experienced losses they could have avoided. Practical steps to embrace continuous learning. Create a learning schedule. Dedicate daily, weekly, and monthly time blocks for studying investing and markets. Diversify your learning sources. Combine books, podcasts, online courses, financial reports, and news outlets. Analyze past investments. Evaluate decisions to identify patterns, mistakes, and successes. Set specific goals. Focus on learning areas that directly improve your investment decisions, such as valuation, risk assessment, or portfolio construction. Apply knowledge immediately. Turn learning into action by testing strategies, even with small investments. Stay curious. Explore new markets, industries, and investment types to expand your perspective. Teach or discuss. Sharing knowledge reinforces understanding and exposes gaps you may have overlooked. Mindset shifts for lifelong learning. Knowledge is compounding. Just as money grows with time, knowledge accumulates and multiplies your ability to make better investment decisions. Curiosity over complacency. Even experienced investors must remain curious. Markets evolve, and yesterday's strategies may not work tomorrow. Action follows learning. Information alone is not enough. Apply insights consistently to benefit from your education. Mistakes are lessons. Every failure or setback offers a learning opportunity. Smart investors analyze and adjust rather than repeat errors. By embracing continuous learning, you position yourself to make informed decisions, anticipate market changes, and navigate uncertainty with confidence. Education compounds alongside your investments, creating a foundation for sustainable long-term wealth. Actionable steps to internalize Rule 4. Set aside at least 30 to 60 minutes daily for financial learning. Subscribe to reputable financial news outlets and investment analysis platforms. Keep a journal of lessons learned from each investment decision. Engage with investment communities to discuss strategies and gain different perspectives. Schedule monthly deep dives into markets, industries, or emerging trends. Test new strategies with small amounts to apply knowledge practically. Reflect on mistakes and successes to reinforce learning and improve future decisions. Mastering the habit of continuous learning equips investors with the tools, knowledge, and mindset to make intelligent, confident, and profitable decisions. It transforms uncertainty into opportunity and prepares you for every challenge the market may present. Part 6. Rule 5. Let emotion guide you carefully. The fifth rule every smart investor learns is that emotion is a powerful tool, but only when managed wisely. Many investors view emotion as an obstacle, something to suppress entirely. While unchecked emotion can destroy wealth, smart investors recognize that feelings, instincts, and intuition can provide valuable insight when combined with rational analysis and disciplined strategy. The key is learning how to harness emotion rather than being controlled by it. The dual nature of emotion. Emotion in investing is both a friend and a foe. On one hand, fear, greed, or overconfidence can lead to impulsive decisions, panic selling, or chasing high-risk opportunities without proper analysis. On the other hand, intuition, empathy, and self-awareness can guide investors to opportunities that align with their risk tolerance, goals, and market understanding. Smart investors treat emotion as data, not a directive. They ask, what is this feeling telling me about risk perception? Is this emotion based on facts or bias? How can I channel this insight into a disciplined action plan? By understanding the source and purpose of their emotional responses, investors transform potential obstacles into strategic advantages. Fear and greed, the primary drivers. Two of the most powerful emotions in investing are fear and greed. Fear. Fear often emerges during market downturns, volatility, or unexpected events. It can trigger panic selling, abandonment of strategy, or hesitation to seize opportunities. Smart investors recognize fear as a signal to pause, analyze, and respond deliberately rather than react impulsively. Greed. Greed drives overconfidence, excessive risk-taking, and chasing short-term gains. It can lead to concentrated bets on speculative assets or overexposure in trending markets. By recognizing greed, investors can impose rational limits, allocate responsibly, and maintain balance in their portfolios. The ability to recognize, interpret, and regulate these emotions separates successful investors from those who repeatedly make avoidable mistakes. Using emotion strategically. Emotion can guide smart investors when harnessed effectively. Intuition. Experience and observation create patterns in the mind. Intuition helps identify opportunities or red flags that may not be immediately obvious through analysis alone. Empathy for market behavior. Understanding collective investor sentiment can provide insight into market trends, overreactions, and potential turning points. Motivation and discipline. Passion for learning, goal-oriented thinking, and emotional connection to financial goals can fuel consistent, disciplined action over time. Emotion becomes a compass, not a rudder. It informs decision-making but does not dictate it. The science behind emotional investing. Behavioral finance studies show that humans are not perfectly rational. Cognitive biases such as loss aversion, anchoring, overconfidence, and herd mentality often interfere with optimal investment decisions. Smart investors learn to recognize these biases and adjust their behavior accordingly. Loss aversion. The pain of loss is psychologically stronger than the pleasure of gain. Investors who understand this bias can avoid panic selling and instead focus on long-term strategy. Herd mentality. Following the crowd often leads to buying high and selling low. Awareness of this behavior allows investors to act independently and strategically. Overconfidence. Believing you are always right can lead to excessive risk-taking. Continuous learning, review of past decisions, and humility help mitigate this bias. By combining self-awareness with disciplined analysis, investors can leverage emotion as a strategic advantage rather than a liability. Case study. Emotion managed wisely. Consider an investor named Marcus. During a market downturn, his tech-heavy portfolio loses 20% of its value. Initially, fear arises, urging him to sell. However, Marcus evaluates the fundamentals of his investments, assesses long-term trends, and recalls his risk tolerance. He chooses to hold and even gradually increase positions at discounted prices. Over time, his disciplined approach leads to significant gains as the market recovers. In contrast, his friend Aaron allows fear to dominate. He sells at a loss, missing the rebound and undermining years of wealth building. The difference is the conscious management of emotion. Marcus let his feelings guide him carefully, while Aaron was controlled by them. Practical steps to harness emotion. Acknowledge emotions. Recognize fear, greed, excitement, or doubt when they arise. Naming the emotion is the first step to control. Pause before acting. Avoid impulsive decisions. Take time to analyze facts and align actions with strategy. Use emotional signals as data. Let feelings indicate areas to investigate further, not mandates for immediate action. Maintain a long-term perspective. Remind yourself of your goals and strategy during periods of market volatility. Set rules and limits. Establish entry and exit points, stop-loss orders, and portfolio allocation limits to prevent emotion-driven mistakes. Reflect on past decisions. Review emotional responses to previous investments and learn from mistakes and successes. Mindset shifts for emotional mastery. Emotion is a tool, not a threat. It can guide insights, motivation, and strategic decisions when managed intelligently. Discipline amplifies emotion. Structure, rules, and long-term thinking turn emotional signals into deliberate action. Reflection builds control. Continuous self-awareness and learning improve the ability to respond rather than react. Confidence reduces panic. Understanding risk, diversification, and strategy allows you to act calmly even when emotions are strong. Smart investors embrace emotion as part of the human experience. They neither ignore it nor surrender to it. Instead, they use it to inform, motivate, and enhance their strategy, creating a resilient and adaptive approach to wealth building. Actionable steps to internalize Rule 5. Keep a journal of emotional reactions to market events. Identify patterns in fear, greed, or overconfidence. Establish rules for decision-making to limit impulsive behavior. Reflect weekly on emotional triggers and responses. Practice mindfulness or meditation to maintain clarity and composure. Use emotional insight to inform research, analysis, and strategic actions. Review successes and mistakes to improve future emotional control. By mastering the management of emotion, investors can navigate markets with confidence, respond strategically to opportunities, and avoid costly mistakes. Emotion becomes an ally rather than an obstacle, enhancing decision-making and long-term wealth creation. Part 7. Rule 6. Focus on value, not hype. The sixth rule every smart investor learns is that long-term success comes from seeking value, not chasing hype. In a world filled with media buzz, trending investments, and sensational stories, it is easy to be swept up by excitement and make impulsive decisions. Smart investors understand that true wealth is built by identifying assets that are intrinsically valuable, sustainable, and fundamentally sound, rather than those merely popular in the moment. The illusion of hype. Hype creates a powerful psychological pull. Headlines, social media, and market buzz make certain investments appear irresistible. While some of these investments may deliver short-term gains, they often carry disproportionate risk. Investors who chase hype frequently buy at inflated prices, expecting quick gains. Overlook fundamental analysis and intrinsic value. Make emotionally driven decisions, such as panic selling during market corrections. Miss opportunities to acquire undervalued assets that grow steadily over time. Hype-driven investing can produce temporary excitement but rarely leads to sustained wealth. Smart investors distinguish short-term noise from long-term opportunity. Understanding true value. Value investing is the practice of assessing an asset's intrinsic worth relative to its current market price. An investment is considered valuable if its long-term potential exceeds its cost. This principle applies across stocks, real estate, businesses, and other assets. Key elements to evaluate value include fundamentals, revenue, profitability, cash flow, and growth potential. Competitive advantage. Does the asset have a sustainable edge that protects long-term profitability? Market conditions. Is the current price reasonable relative to historical performance and intrinsic value? Future potential. Will the asset generate returns over the long term, independent of short-term popularity? By focusing on these factors, investors make rational, informed decisions rather than being swayed by fleeting trends. The psychology behind hype. Humans are naturally drawn to stories, trends, and fear of missing out, FOMO. Investors are no exception. Hype leverages cognitive biases such as herd mentality, following the crowd without independent analysis; recency bias, assuming recent performance predicts future results; Overconfidence. Believing one can perfectly time the market based on hype. Recognizing these biases is essential for building discipline and resisting temptation. Smart investors consciously counteract hype with careful evaluation and a value-oriented mindset. Case study: value over hype. Consider two investors, Anna and Brian. Anna reads about a new tech stock that has skyrocketed due to media attention. She buys in at a high price, driven by hype. Within months, the stock experiences a sharp correction, and she loses a significant portion of her investment. Brian evaluates the same market but focuses on a different company with strong fundamentals, consistent revenue growth, and undervalued assets. He invests patiently, and over several years, his position grows steadily, unaffected by short-term hype or market noise. The difference is clear. Focusing on value rather than hype leads to sustainable wealth accumulation, while chasing trends exposes investors to unnecessary risk. Practical strategies for value investing. Analyze fundamentals. Study financial statements, cash flow, profitability, and growth potential before investing. Look beyond popularity. Avoid investing solely because an asset is trending. Evaluate the long-term potential independently. Calculate intrinsic value. Compare current market price to intrinsic worth using metrics such as discounted cash flow, earnings multiples, or real estate valuation. Focus on long-term growth. Choose investments that compound value over time, not those with speculative short-term appeal. Avoid emotional decisions. Be aware of FOMO and market noise, and ensure every investment aligns with strategy and research. Diversify within value. Select multiple assets with strong fundamentals to reduce risk and enhance growth potential. Monitor regularly but don't overreact. Keep track of investments' performance and fundamentals, but avoid reacting to every trend or headline. The mindset of value-oriented investors. Value-oriented investors share common traits. Patience. They understand that wealth builds over years, not days. Rationality. Decisions are based on data, not emotion or hype. Curiosity. They continuously seek knowledge to evaluate opportunities accurately. Resilience. They remain confident in their analysis, even when others panic or follow trends blindly. Discipline. They maintain consistency in strategy, resisting impulses to chase speculative gains. By cultivating this mindset, investors position themselves to recognize opportunities others overlook and avoid the pitfalls of short-term excitement. Common mistakes to avoid. Buying because of popularity. Don't equate media attention or social buzz with investment quality. Ignoring fundamentals. Hype cannot replace solid analysis of financial health and growth potential. Reacting to market noise. Price fluctuations or trending assets may be temporary. Focus on intrinsic value. Overconcentration in trendy assets. Allocating too heavily to popular investments increases risk. Avoiding these mistakes ensures that your portfolio is guided by sound judgment, not external pressures. Actionable steps to internalize Rule 6. Develop a process for evaluating intrinsic value before investing. List criteria for high-quality investments, focusing on fundamentals, competitive advantages, and long-term potential. Avoid making decisions based solely on trends or media coverage. Regularly review investments to ensure they maintain strong value characteristics. Diversify across multiple value-driven assets. Practice patience, allowing investments to grow according to fundamentals rather than hype. Reflect on past decisions influenced by trends and identify lessons learned. By focusing on value over hype, investors create a portfolio built on solid foundations, capable of weathering market volatility and generating consistent long-term growth. Part 8. Rule 7. Protect capital at all costs. The seventh and final rule every smart investor learns is that capital preservation is the cornerstone of all wealth building. Without capital, even the best opportunities cannot be seized, and long-term growth becomes impossible. Protecting what you have is as important, if not more so, than seeking returns. Smart investors understand that growth comes from a foundation of safety, discipline, and strategic foresight, and they prioritize safeguarding their resources before taking calculated risks. The importance of capital preservation. Capital is the fuel that powers financial growth. Every investment, no matter how promising, requires an initial allocation of funds. Losing capital reduces the ability to take advantage of opportunities and slows the compounding process, which is essential for building lasting wealth. Even a small loss can require a disproportionately large gain to recover. For example, a 50% loss requires a 100% gain to break even. This illustrates why protecting capital is not just a cautious approach, it is a strategic necessity. Principles of protecting capital. Avoid unnecessary risk. Not all investments are worth pursuing. High-risk ventures may offer large potential returns, but without careful assessment and risk mitigation, they threaten the foundation of your portfolio. Focus on preservation before growth. Always ask, how can I structure this investment to minimize potential losses while capturing reasonable gains? Protecting your principal should be the first priority. Diversification as protection. Spreading investments across asset classes, sectors, and geographies reduces exposure to any single source of loss. Diversification is a form of capital insurance, safeguarding your ability to invest in the future. Due diligence and research. Thoroughly investigate every opportunity. Understand the business, asset, or market dynamics before allocating funds. Uninformed decisions are the fastest path to eroding capital. Maintain a safety margin. Only invest what you can afford to risk. Maintaining liquidity and reserves ensures you can survive downturns and unexpected financial challenges without panic selling. Avoid leverage without strategy. Borrowed funds can amplify gains, but they also magnify losses. Leverage is a tool for experienced investors who understand risk management. For most, it is a dangerous temptation. The psychology of capital protection. Many investors focus solely on growth, chasing high returns without considering the cost of potential losses. This mindset often leads to reckless decisions, emotional panic during downturns, and permanent setbacks. Successful investors adopt a long-term, disciplined mindset. Patience over impulse. Avoid chasing immediate profits at the expense of stability. Preparedness over reaction. Anticipate market volatility and plan for adverse scenarios. Rationality over emotion. Let analysis and strategy guide actions, not fear or greed. By embedding these principles into daily investing habits, capital preservation becomes second nature rather than an afterthought. Case study: protecting capital in action. Consider two investors, Rachel and Tom. Rachel invests in a high-risk startup without proper research, hoping for massive returns. Within a year, the company fails, and she loses her entire investment. She is now cautious and must rebuild her capital from scratch. Tom evaluates the same opportunity, analyzing potential risk and reward. He decides to invest a smaller, calculated portion of his capital while maintaining diversified investments in more stable assets. Even when the startup fails, Tom's overall portfolio remains intact, and he is ready to seize new opportunities. Tom's focus on capital preservation ensures that losses do not cripple his wealth-building journey. Rachel's neglect of this principle delays her progress and increases stress. Practical strategies to protect capital. Prioritize safety in asset allocation. Include a mix of low-risk, income-generating assets to maintain stability. Balance these with growth-oriented investments for long-term appreciation. Set stop-loss and exit strategies. Predefine conditions for selling or reducing exposure to protect against catastrophic losses. Perform thorough due diligence. Evaluate historical performance, financial health, competitive advantage, and market conditions before investing. Maintain liquidity. Keep a portion of capital in cash or easily accessible assets to handle emergencies and seize unexpected opportunities. Avoid emotional decisions. Stick to your investment plan. Do not make hasty decisions driven by fear, greed, or market hype. Review and adjust regularly. Periodically assess portfolio performance, risk exposure, and allocation to ensure capital remains protected. Limit leverage. Use borrowed funds cautiously, if at all, and ensure risk management measures are in place. Mindset shifts for capital protection. Preserve first, grow second. Protecting your foundation enables sustainable wealth growth. Risk is not enemy, but managed risk is ally. Avoid unnecessary exposure while pursuing calculated opportunities. Think long-term. Short-term setbacks are inevitable, but protecting capital ensures you remain in the game. Discipline creates freedom. Maintaining structure and rules allows flexibility and resilience in uncertain markets. Smart investors treat capital as the most valuable asset. By prioritizing its protection, they gain the freedom to pursue growth opportunities without fear of catastrophic loss. This mindset distinguishes successful investors from those who are constantly reacting to volatility. Actionable steps to internalize Rule 7. Review all current investments for risk exposure and potential losses. Allocate capital with preservation as the guiding principle. Maintain a diversified portfolio to reduce dependency on any single asset. Establish stop losses, exit strategies, and liquidity buffers. Avoid high-risk speculative investments that can threaten the foundation of wealth. Regularly reassess risk and adjust allocations as markets and personal goals evolve. Keep learning and refining strategies to maintain a balance between protection and growth. By consistently applying this principle, investors ensure that capital remains safe, opportunities are preserved, and long-term wealth can grow without interruption. Protecting capital at all costs is the final safeguard, the ultimate discipline, and the hallmark of a smart investor. Part 9. Integrating the 7 rules into a cohesive strategy. Having explored each of the 7 foundational rules, the next step for every smart investor is integration. Knowledge alone is insufficient. Applying these principles cohesively transforms potential into real, lasting wealth. A strategy built around discipline, learning, risk management, value, emotion, and capital preservation allows investors to act with clarity and confidence, even in unpredictable markets. The power of synergy. Each of the 7 rules supports the others. Understanding this synergy is critical. Start early. Beginning early compounds not just money but experience, allowing time to absorb lessons and recover from mistakes. Discipline and consistency. Regular, disciplined action ensures that learning, risk management, and strategy are consistently applied. Understand risk before reward. Risk awareness protects capital and informs smarter growth decisions. Embrace continuous learning. Knowledge strengthens decision-making across all areas, from evaluating opportunities to controlling emotion. Let emotion guide you carefully. Emotional intelligence enhances judgment and ensures decisions are aligned with strategy. Focus on value, not hype. A value-oriented approach keeps investments grounded, reducing exposure to fads and speculation. Protect capital at all costs. Capital preservation provides the foundation from which all other rules can generate wealth. When applied together, these principles form a robust, resilient framework for long-term success. Ignoring one rule weakens the structure, exposing the investor to risk, emotional error, or missed opportunity. Creating your personal investment framework. To integrate these rules effectively, each investor must develop a personalized framework that suits their goals, resources, and risk tolerance. This framework includes 1. Goal setting. Establish clear financial goals. Short-term, build emergency funds, save for specific purchases, or secure low-risk investments. Medium-term, acquire growth-oriented assets, diversify portfolio, and develop passive income streams. Long-term, achieve financial independence, retire comfortably, or build generational wealth. Goals guide every decision, ensuring that each investment aligns with your overall strategy. 2. Portfolio construction. Using the 7 rules, structure your portfolio to balance growth, risk, and protection. Core assets. Stable investments that generate consistent returns and preserve capital. Growth assets. Carefully selected opportunities with strong fundamentals and value potential. Speculative assets. Small, calculated positions in emerging markets or high-growth sectors, where risk is understood and managed. This layered approach aligns with disciplined risk management, value assessment, and emotional control. 3. Decision-making process. Develop a repeatable, rule-based process for evaluating opportunities. Assess risk versus reward. Analyze intrinsic value and fundamentals. Check alignment with long-term goals and personal risk tolerance. Factor in emotional and psychological readiness to act. Execute disciplined entry, monitoring, and exit strategies. By following a structured process, impulsive decisions, hype-driven moves, and emotional errors are minimized. Daily and weekly practices. Integration of the 7 rules is not a one-time event. It requires consistent practice. Daily review. Monitor market news, asset performance, and portfolio status. Learning habit. Dedicate time each day to read, analyze, or study trends, opportunities, and strategies. Emotional check-in. Pause to identify feelings influencing investment decisions. Risk assessment. Evaluate whether current exposures align with your risk tolerance and strategy. Journaling. Record lessons, successes, mistakes, and insights for continuous improvement. Weekly reviews can include performance assessment, portfolio rebalancing, and reflection on decisions made with or against the rules. The role of patience and discipline. Patience and discipline are the glue that holds these rules together. Wealth building is a marathon, not a sprint. Impatience leads to chasing trends, ignoring fundamentals, or overreacting to market swings. Discipline ensures that the 7 rules are applied consistently, regardless of market noise, hype, or fear. Case study: applying the 7 rules. Consider Emily, an investor who integrated the 7 rules into her strategy. Early start: she began investing in her 20s, taking advantage of compounding. Discipline: she contributed regularly to her portfolio, avoiding impulsive withdrawals. Risk assessment: before each investment, Emily evaluated potential losses, hedging when necessary. Continuous learning: she dedicated daily time to studying markets and trends. Emotion management: when markets dropped, Emily avoided panic selling, relying on her disciplined process. Value focus: she selected assets based on intrinsic worth, avoiding speculative fads. Capital protection: she maintained liquidity and diversified holdings, safeguarding her foundation. Over a decade, Emily's portfolio grew steadily. When market volatility arose, she acted strategically, turning potential losses into opportunities. Her success demonstrates the power of integrating the 7 rules cohesively. Mistakes to avoid: neglecting one rule. Ignoring any single rule weakens the framework and exposes you to avoidable loss. Reacting emotionally: abandoning strategy during market fluctuations leads to missed opportunities and mistakes. Overcomplicating strategy: keep processes simple and aligned with your risk tolerance and goals. Ignoring learning: markets evolve. Failure to continue learning reduces adaptability. Chasing trends: hype may create short-term gains but often destroys long-term value. Avoiding these pitfalls ensures that the framework remains strong and effective. Actionable steps to integrate the 7 rules. Write down each of the 7 rules and reflect on how they apply to your current investments. Audit your portfolio to ensure alignment with principles like value, risk management, and capital protection. Create a disciplined decision-making checklist based on the rules. Establish daily, weekly, and monthly practices for learning, review, and emotional assessment. Identify gaps in knowledge or strategy and address them proactively. Use journaling to track decisions, emotions, and outcomes for continuous improvement. Commit to applying these rules consistently, recognizing that discipline and patience compound as much as capital. By integrating the 7 rules into a cohesive strategy, investors gain clarity, confidence, and resilience. They are equipped to navigate volatility, seize opportunities, and build wealth steadily over time. Part 10. Advanced strategies and full implementation. As we reach the culmination of 7 rules every smart investor learns early, it is time to transition from understanding principles to implementing them fully in your financial life. Knowledge is only powerful when applied consistently. This final part focuses on advanced strategies, practical systems, and disciplined execution to ensure these 7 rules transform your investing journey into long-term wealth creation. Turning principles into action. The 7 rules: starting early, disciplined investing, understanding risk, continuous learning, emotional mastery, value focus, and capital protection, form a foundation. However, to truly thrive, these principles must be embedded into daily, weekly, and long-term practices. Wealth is not built by occasional good decisions but by the compounding effect of consistent, intelligent actions over time. Start early. Time is the greatest ally. The earlier you act, the more opportunity there is to compound returns and refine strategy. Discipline. Establish routines for investing, research, and portfolio review. Consistency compounds faster than sporadic effort. Risk awareness. Always measure potential downsides before committing capital. Implement stop losses, diversification, and hedging strategies. Continuous learning. Treat education as a daily practice. Stay informed about markets, economic indicators, and emerging opportunities. Emotional control. Make decisions from strategy, not panic or euphoria. Use journaling and mindfulness to manage impulses. Value focus. Evaluate assets on intrinsic worth rather than popularity, hype, or media influence. Capital preservation. Protect the foundation of your wealth to maintain freedom and flexibility in decision-making. These principles should never be theoretical. They are most effective when codified into repeatable habits and systems. Building your actionable investment system. A systematic approach removes guesswork, reduces emotional influence, and ensures consistency. Step 1. Define your investment goals. Short-term. savings for emergencies, specific purchases, or low-risk growth. Medium term, portfolio expansion, diversification, and income-generating assets. Long term, financial independence, generational wealth, or retirement security. Clear goals guide asset allocation, risk tolerance, and decision-making processes. Step 2. Establish a portfolio framework. A strong portfolio balances growth, protection, and adaptability. Core portfolio, stable assets such as index funds, bonds, or dividend-paying stocks. Growth portfolio, value-driven investments with strong fundamentals and future potential. Speculative portfolio, small, calculated positions in high-growth sectors, cryptocurrencies, or startups. This framework ensures diversification while maintaining focus on both safety and opportunity. Step 3. Implement rules as decision-making tools. Each rule becomes a checkpoint in your decision process. Does this investment align with my goals? Have I evaluated the risk carefully? Is it fundamentally sound and undervalued? Have I considered the emotional and psychological impact? Does it protect my capital or expose me unnecessarily? Have I conducted sufficient research and learning to feel confident? Does it fit within my disciplined portfolio structure? Answering these questions systematically turns principles into actionable steps that guide every decision. Advanced strategies for smart investors. Beyond foundational rules, advanced strategies amplify wealth-building potential. 1. Dollar cost averaging. Invest consistently, regardless of market conditions. This strategy reduces the impact of volatility and ensures disciplined accumulation over time. 2. Tax efficiency. Leverage tax-advantaged accounts, understand capital gains implications, and structure investments to minimize tax burdens. Smart tax planning preserves more capital for reinvestment. 3. Risk hedging. Use options, bonds, or alternative investments to hedge exposure in volatile markets. Hedging is not speculation. It is protection for your capital and portfolio integrity. 4. Strategic rebalancing. Periodically review and adjust portfolio allocations to maintain desired risk, reward ratios and ensure alignment with long-term goals. 5. Networking and mentorship. Engage with other investors, financial advisors, and mentors to gain insight, identify trends, and refine strategies. Experience combined with knowledge accelerates growth. 6. Scenario planning. Prepare for various market outcomes: recession, inflation, geopolitical disruptions, and technological disruption. Planning ensures that you remain flexible, confident, and ready to act. Developing the mindset of a smart investor. Advanced implementation is as much about psychology and mindset as it is about strategy. Patience. Wealth accumulates over time. Resist the urge for immediate gratification. Discipline. Follow systems rigorously, even when emotions or trends tempt deviation. Resilience. Accept market volatility as inevitable. Stay focused on long-term goals. Adaptability. Continuously learn and adjust strategies based on new data, trends, and insights. Confidence without overconfidence. Believe in your analysis, but remain humble and open to learning. These mindset traits turn principles into sustainable habits that compound over a lifetime, ensuring you remain ahead of the average investor. Practical steps to full implementation. Audit your current investments and align them with the 7 rules. Develop a decision-making checklist incorporating risk, value, emotional assessment, and capital protection. Implement daily and weekly routines for research, learning, and portfolio monitoring. Allocate capital according to a disciplined portfolio framework with diversified core, growth, and speculative segments. Use journaling to track decisions, outcomes, and emotional responses. Apply advanced strategies like dollar cost averaging, tax planning, rebalancing, and scenario planning. Review progress quarterly and annually, adjusting systems and strategies as needed. By following these steps, every investor can transform principles into practical actions, ensuring consistency, discipline, and long-term wealth creation. Case study. Full implementation in action. Consider David, an investor who internalized all 7 rules and implemented them fully. He started investing early, allocating funds across diversified assets. He adhered to disciplined contribution and reinvestment strategies. He assessed risk, applied value investing, and avoided hype-driven decisions. He managed emotion during market downturns and protected capital through careful allocation and hedging. He continuously educated himself, refined strategies, and leveraged networking for insights. Quarterly, he rebalanced and reviewed his portfolio against goals and risk tolerance. Over a decade, David's disciplined approach compounded wealth steadily. Market volatility provided opportunities rather than threats. His confidence, knowledge, and capital preservation enabled him to grow assets beyond peers who relied on luck or impulsive strategies. Final mindset shifts for implementation. Action trumps knowledge alone. Principles matter only when applied consistently. Consistency is more powerful than speed. Steady, disciplined progress outperforms sporadic bursts of activity. Learning and adaptation are continuous. Never stop improving strategy, knowledge, and emotional control. Protect capital relentlessly. Preservation ensures freedom, resilience, and the ability to seize opportunities. Wealth is a marathon. Long-term commitment, not short-term speculation, defines success. By internalizing these lessons and embedding them in daily practice, every investor can transform understanding into measurable results, building a portfolio and mindset that endure through all market conditions. Actionable steps to conclude. Commit to applying the 7 rules in every investment decision. Develop and follow a structured, repeatable investment system. Implement daily and weekly practices to monitor, learn, and refine your strategy. Leverage advanced strategies for compounding, tax efficiency, and risk management. Review and reflect regularly, adjusting plans to maintain alignment with goals. Cultivate mindset traits of patience, discipline, resilience, adaptability, and confidence. Treat investing as a lifelong journey where learning, strategy, and action compound simultaneously. This final step transforms theory into practice, turning smart investors into exceptionally capable wealth builders who thrive in every market scenario. By committing fully, applying discipline, and leveraging knowledge, you set yourself on the path to financial independence and lasting wealth.